Good afternoon and welcome everybody. This is the second session for the second day of the Risk Academy week. Today we're touching not a new subject. Yes, it's all about non-performing loans, but I think we're approaching it from a fresh angle. Yes. We have a large number of speakers today and a lot of material to cover. So I will just go through the speakers for the day in the agenda. Could we go to the next slide, please? Yes, the next one, please. Thank you. Okay, so some housekeeping for the day. Yes, so we are able today to you can ask questions. Yes, the participants are muted. We are a big group today. But you can log questions, and the questions are going to be addressed from the panel as much as we can. Yes, what we leave, what we cannot cover, then we're going to contact in private with you to respond to the question. So how are we going to approach the agenda of the day? Yes, so we are going to discuss a little bit on the reasons of what drives the NPL generation and the NPL stockpile right now. Yes, partially is the economic recovery or the lack of it, and partially is the regulation itself. Yes, and then we are going to pass the torch from a more practical perspective. Yes, to a different panel of speakers where they're going to address more the transactional perimeter of non-performing loans. Yes, we're going to discuss more actively about the market, about the sellers and the buyers. Yes, so we want to give a very well-rounded view. So in the first panel, together with me, we have Clea from Cyprus. She's a partner with the risk advisory team. And we also have Hervé from Paris. He's also a partner of the risk advisory team. Clea focuses more on regulation part, I would say, and then Hervé approaches it from a credit risk perspective. If we can go, and then the second panel, yes, we have Niels, Chrissa, Albert, and Alok. Yes, so I will let the second panel to be introduced by Alok shortly after. We can go to the next slide, please. Yes, and the next one. Okay, so a little bit about not something you don't know, but factors that we have identified that is promoting either the generation or the measurement of the NPLs. Yeah, so we're showing nothing new on this slide. So on one hand, you have the Eba Guidelines, which is known to all of us, a bit updated through the years, but not very different from what was sorry, from what was applied in the last crisis. Yes, so both on the recognition and the forbearance, potentially the supervisor is becoming more active, more experienced, and more strict. Yes, what changed this year is the new default definition. Yes, so again, I will not approach it from a technical perspective. It's something that's well known to all of us. I'm just approaching it from a strategic perspective. It has the impact of the new default definition across the sector. Yes, is the recognition of more NPLs. Yes, it's a stricter approach of recognizing the NPLs. Yes, and then the last part on secondary markets and insolvency. Again, it's an area that has been approached with a lot more caution from the regulator, and it gives its own perspective, I would say, on how the individual markets are dealing with the NPL. Yes, but this is the pretty much I would say the main pillars of the NPL regulatory environment that we have to deal with. Yeah, and then if we could go to the next slide, please. And then the question is why the NPL stock is increasing. Yeah, so our view is that it is increasing. Some of these metrics are not fully visible right now because of the moratoria, but this is the expectation. So I think that the discussion in the market, in the banking sector, in firms like ours, like consultants and the regulators, is how much is this change? Yeah, so I think this is the big question mark. So how NPL stock is increasing either in absolute or in proportion to the lending. Yes. So the first reason is that the new lending during the pandemic, yes, was to a certain degree halted. So the first reaction from the banks is to stay with the clients they know, yes, especially on the corporate area, and not take huge risks, yes. So new lending, so the balance sheet of the banks became static, yes, with a certain portion of it deteriorating. And then what we saw across the industry is new lending was more encouraged in unsecured loans like retail loans and SME rather than the corporate side. Yes, there was biggest fear in this perspective. So all things equal, yes, if a portion of the loan started deteriorating, then the absolute number would grow, but then it would grow exponentially in terms of a percentage of the loan book, yes, which then starts becoming a question of how close you are to this 5% threshold, yes, or by which extent you're exceeding. The second factor in the NPL creation is moratoria. So, which is also, I would say, an umbrella that prevents us from seeing the real numbers right now. As we are approaching the end of moratoria, the question mark is how many of these loans, how many of these protected borrowers will be able to return to a AAA health status for the bank. Yes, and I think that this is a test where we're waiting to see. And this is also, I think, an area of potentially the concern of the regulator about the data that they have right now. Yes, so ECB in the November financial stability report said very actively that they cannot really trust the data trends that they see. Yes, because moratoria is contaminating these data trends. Yes, but this summer, the end of moratoria in some countries. Other countries, we already see extensions, something we're going to discuss even more. But I think it's going to be the first test of how many of these SMEs or small corporates can survive inside moratoria, yes, and exit moratoria with a sufficient health status, yes. And then at the end, the collection strategy as a factor in the increasing stockpile of the NPL, again as a portion of the loan book. So there has been a delay of how the troubled loans are being dealt with, yes, and that has to do a lot with lack of visibility. Yes, to be able to put together a repayment plan or a restructuring plan for the borrower, to be able to resegment your portfolio and develop new collection strategies. So all in all, we have more generation of NPL loans, some hiding inside moratoria, yes, and then on the dealing with the existing NPL, we have a delay, yes, because of lack of visibility. Yeah. So this is, in our view, the framework which pushes the current numbers up. Yes. Could we go to the next slide, please? And then, despite the lack of data, and I think that in the last quarter of the calendar year, we're going to be able to discuss in a lot more detail about the data trends we see. We're going to be in most countries well out of the moratoria, so data is going to be available to us. But as we discuss right now, we have some information from the EBA dashboard, and then we also have some of the expectations that are coming to us from the regulator. Yes, so we see again how the EBA is defining the most affected countries, yes, when it comes to SME, and where we see the majority of the NPL formation. But so the numbers so far validate the expectation, yes, that we're going to have an upwards trend in the NPLs, both in terms of stockpile, yes, and as a proportion of the entire loan book. The question is, and I think this is what the market is debating today, what is where are we going to land? Yes, and I think this is the big division in views, I would say. On one hand, you have the sector saying that we were perhaps too careful inside the pandemic. Yes, we haven't realized as much of the worst case scenario that we had in mind, for which we prepared. And then on the other hand, you have the European regulators, yes, the messages coming from SSM and very often from Mr. Enria himself are quite specific. Yes, in the last financial stability report, ECB expected in the worst case scenario 1.4 trillion of additional NPLs. Yes, and then in the famous letter of Mr. Enria to the banks, there was a very specific focus, yes, on how quickly we can understand, yes, and deal with the deterioration of the asset quality. Yes, so I think this is the unknown factor. We know the direction, but we don't know the impact yet. Yeah, and if we could go to the next slide, please. And finally, so we mentioned how the regulation is recognizing more pretty much the new default of definition, and then we talked a little bit about the COVID impact. Yes, so moratoria, no matter how much you put under protection certain sensitive borrowers, surviving after 2 years of non-operation or suboptimal operation is quite a big deal. For any SME and for any corporate, I would say. And then finally, we come to the current economic outlook. Yes, and again, I will not go to the whole detail in the slide, but I would say there has been a big bet on the European recovery. Yes, and the reality is that the pandemic has affected countries and sectors in very different ways. Yes, which then again the financial impact followed the same footprint. So it is safe to assume that recovery is going to follow again the same conditions. Yes, so there's not going to be, we're not expecting a uniform recovery across the board. Yes, not for all countries recovery is going to be the same, and not for all sectors recovery is going to be the same. Yes, and then we started already having I would say slight question marks about the recovery. Yes, whether there is an expectation that things will be open, or whether there are news, international news about different variants imposing measures again on economies that had a very specific plan to open. All of this is creating a level of uncertainty in the market, in the borrowers, and in the banks. Yes. And with this in mind, I would like to address my co-speakers for the day. Yes, so Hervé, you represent a market where it hasn't been very well experienced with NPLs. Yes, and then Claire, you're coming from a market which had extensive experience with the NPL market. Yes, so in lack of better data, yes, because we are exactly on the exit, or perhaps we are not in the exit of moratoria, but what is your observation from the respective markets?
I don't know if Hervé wants to go first.
So maybe I can start quickly. Where in France, you mentioned the moratoria, but I would say that in addition of the moratoria, there is something else which is affecting the market even more deeper, I would say, actually. It's the forthcoming election. As you know, we have a forthcoming election in 2022, and the direct impact of that is that there is, and we can observe both very huge governmental support, but also very huge delay in the legal enforcement of failures and defaults. To be practical, that means that as of today, if we are looking at numbers at the end of March, starting from the beginning of the crisis, or at least the lockdown period in the March 2020, comparing to an historical trend, we have approximately 30,000 defaults less than usual, without any consideration of what could be the next coming economic crisis, which is not there yet, because we are still in this momentum where, let's say, the COVID crisis is not well and very well transformed into an economic crisis. So that means that even if we are taking some of the last information we have from the governments, meaning that apparently after the moratoria and regarding the first type of reimbursement, we only have 5 or 6% of people that are not able to pay. In fact, even considering a normal year, we know that we have a wave of default which is coming somewhere and sometime. We don't know exactly where and we don't know exactly when, but we know that it should come. So there is, as you said, an impact both on the NPA management for sure, and also on the lending practice, because as long as you do not have this kind of information, that means that you need to be very reactive, even in the sector which are well known, and with people you well known also. So that's still something which is limiting the lending practices. In terms of NPL management, we should also keep in mind let's say one of the last indication or measure from the ECB regarding the addendum on the NPL management and the limitation in terms of threshold of time. NPLs should stay into management before closure. My understanding of the market is that, as you said, we do not have a very high experience of the secondary market. We are a high potential country for this market, but we have a high potential since years. So I know that Risa, with talking after me, will develop that aspect. But I think that some of our clients are starting to think about how they can prepare their framework to this wave which is coming, meaning both working on their internal framework, operational one, but also starting to, let's say, move a little bit on this aspect, moving to something which is more relative to recurrent NPL transactions more than very huge ones, at least for the moment, which doesn't mean that if we have suddenly a big wave that is coming, that we'll not have to do something else.
Yeah, but before we go in the transactional part, which is the second panel of our session, so you're working a lot in France, you're working across Europe and not only. So what is the sense you're getting from the banks that you're interacting the most? Is this a real concern, or is this sort of a discounted concern for the time being?
That's a good question. I would say that we are more or less standing in the middle. I know that my answer is not the good one, but that's the only one I think about. What I mean by that is that for the moment, banks feel more or less confident on the fact that they have satisfying provision amounts.
Okay.
That doesn't mean that the NPLs will be well managed, but that means that in their perspective, the risk is correctly handled.
Yeah. Okay.
Which of course is something that could be a question, because as we do not have observation, there is nothing to calibrate statistically, so that's only a matter of expert judgment.
Yeah. Claire, coming to you. So the Cypriot banks know very well both the NPL regulatory environment and special attention from the supervisor. So it has been a very painful subject as Cyprus emerged from the last financial crisis. Yes. So how are you reading the market right now?
So basically, as you mentioned, Dimitris, the direction of travel from the European Central Bank is pretty clear, right? The anticipation is that there will be additional non-performing loan exposures. And this is a hard message to give to Cypriot banks, I would think, because they've spent the past 7-8 years under a lot of pressure to clean their balance sheets. We have been reacting this, our balance sheets significantly. There's more to come on that later in this session. So the message of we need to go back to a position that we've spent years managing, it's a difficult one. Having said that, in terms of concerns, I think at least the banks we are interacting with are providing a message similar to what Herb just mentioned, in that there is confidence that they're not in the position that they were 7 or 8 years ago. They are a bit, more well capitalized as a result of all these efforts over the past few years. Obviously, the the limiting of the buffers that ECB requires in terms of capital helps a lot. But having said that, having spent the exercise of responding to Mr. Enrique's letter from the end of last year, I think we are about to start seeing a number of NPL ratios. I think that, coupled by the exogenous factors that Herbert just mentioned, we too had elections just now. So where there was a lot of good work done on foreclosure laws and so on, those were suspended as a result of recent parliamentary acts, probably as a result of the elections. So that drives another factor that creates an issue. And the fact that we are predominantly a financial services and a tourist industry driven country, the same as most Southern European countries. And we lost the season last year for the hotel and tourism industry. We were able to sustain good results, but if we miss this season this year as well, it would be a challenge for us, as with other countries in our position, to be honest.
Yeah, I think this is a pattern for all the countries in the south of Europe. Yes, the ones that are very exposed to the tourism industry. And then one last question to both of you. I think that at least from what I observe in Central and Eastern Europe, in the last decade, there was at some point overcapacity built internally in the bank when it comes to workout, when it comes to the restructuring department, when it comes to auctioning teams, and which later on, as the asset quality improved in the books, yes, this capacity was reduced substantially. So and I see now early efforts, yes, not very brave efforts, but I see early efforts of the banks trying to build up this capacity again. Is this something that you also observe in your respective markets? Hervé?
I'm not sure we can say that we are globally in the top level of NPL management. Okay. I would say that we have seen there are some teams. Generally, when we are talking about big institutions, there is a real lack of industrialization and centralization of these teams. We have a lot of very local teams everywhere and so on, which, by the way, is not really fit for flexibility and adjustment regarding the size of NPL portfolio or any very specific measure. So in my opinion, and that's also the case for the larger banks and the big networks, I would say it like that, in the banking industry, there is not so much synergy that I have been implemented yet, and there is really this lack of industrialization and centralization. So, in my opinion, if there is let's say this threat of wave of NPL that is coming, it should drive these networks to start working more centrally on that.
Okay. Claire, your impression?
From our side, similar messages to what you observed in Central Europe, to be honest with you. So in a number of our largest transactions, when it came to the sales, actually, we saw a complete set of departments being shifted out of institutions into, credit acquiring companies, as we call them, so that basically the bank no longer has to absorb that cost, and then they're shifted into whomever the buyer is, just because they know the portfolio so well. Having said that, that isn't really applicable to all of our institutions just by virtue of the composition of the portfolios. So some of our loans are not really of high quality to sell. So by virtue of that, a lot of the banks are actually entering into agreements with servicers and then shifting people into servicers rather than just a complete total sale of assets. But similar messages to what you've been seeing, Dimitris.
Interesting. Thank you both. I think it's time to pass to the next panel and try to let Alok and the panelists explain to us a little bit the development from a market perspective. Yes, maybe there is more clarity. Alok, Niels, Chrisan, would you mind joining?
Thank you so much, Dim. Maybe I'll get us started off. My name is Alok Gerotra, and I head up the portfolio lead advisory team for the firm out of the UK. We're a team that's focused on non-core and non-performing loan transactions, so working with banks around capital and balance sheet optimization, and then setup of non-core units, platform carve-outs, etc. While it's a global team, our recent focus post the financial crisis the last time around has been primarily in Europe, working with the wide network that we have of member firms in each country. I'll probably take 2 minutes to walk through the outlook that we see for the market, and maybe we go to the next slide. So essentially, from an NPL transactions perspective, we saw portfolio markets go into a deep freeze early on in 2000 as the private equity buyers kind of stepped away and the bid-ask spreads got widened. The sales processes that the banks had came to a stop. So, and including in the second half of the year, we saw deal activity fall off by almost 60+% across Europe. Given the anticipation of the deterioration in asset quality, we saw the largest European banks provision in excess of 100 billion in 2020, which was almost twice the levels that we had seen in previous years. More recently, we've seen some of this provisioning taper off given the recovery in macro, and some banks have also started writing back provisions, but that's still early days. So while we continue to track bank results as they come out, 2020 obviously was a year in which you saw significant increases in provisioning. The key factor that we probably looked to was the migration of loans between stage 1 to 2 and 3 under IFRS to give us a sense of what is to come. There was a significant increase in IFRS 2 loans, while the NPLs or the IFRS, or the stage 3 loans have actually fallen over the last year. And I think we believe that that's primarily because moratoria is still in place. Things haven't started to normalize yet. Banks still don't have a full understanding of the distress that's likely to be seen in the underlying borrowers. And so we've actually seen NPL ratios fall to 2.6% at the end of Q4 last year. And this, obviously this also is as a result of the unprecedented levels of government stimulus and regulatory forbearance measures that we've seen. I think since the start of the pandemic, we've seen 900+ billion of European loans that have received support. 70% of these in countries like France, Spain, and Italy, where again I think it points to where we're likely to see issues going forward. I think despite obviously the declining trend in NPL volumes, I think the expectation is that as moratoria start to wear off and as as banks do a deeper dive of their loan books and as the stress starts to feed through in borrower balance sheets, there will be an increase in NPL ratios going forward. We've seen some transaction activity pick up, and some of the transactions that were put on hold in 2020 come back in 2021. But I think the expectation is that this will significantly pick up at the back end of this year and then going into 22, 23. Some of the other themes that we've seen from a pricing perspective are that investors, while they're paying up headline prices to what the banks have expected in the past, they are getting into the SPA and structuring it a little bit more in terms of deferred payments, payments linked to the performance of a business plan, etc. So it gives them a little bit of leeway to still end up hitting their returns. The other bits that we've seen, obviously, as in the current crisis, the banks are way better capitalized than they were at the end of the GFC. So there should be the ability, the willingness to take a little bit of pain in terms of portfolio sales. And this is also linked to some of the bits that the earlier panel talked about, where workout capacity is not necessarily at the levels where it used to be. And you've seen a lot of banks carve out some of these units and sell them to investors in the last couple of years. The other factor that we're seeing is the private equity capital money. So private equity has done, has raised a significant amount of capital in the last few years as a result of the opportunity that they expect to come down the line. So I think there is obviously a lot of money waiting on the sidelines to make those investments. So it should be interesting to see how things pan out over the next couple of years. I think just moving on to the panel discussion, I think we've got 4 countries here today, or 4 countries regions. I'll probably ask each panelist to introduce themselves in a couple of minutes and also cover off some background material that talks to, how they've seen the current crisis in the relative country or region, what sectors have been impacted, what the impact of the moratoria has been and the government support that's been put in place, and also what the situation is with the banks from a capital NPL perspective and the developments that they see over the last couple of years. I might ask Niels to start us off on Germany.
Sure. Thank you very much, Alok. So good afternoon. So my name is Niels Behrendt. I'm a Germany-based partner, and I lead the German portfolio and loss and loans transactions group, which we call PLAS. I'm advising banks in Germany now for over 15 years, and today I'd like to talk to you about the German market. And as you can see, in Germany, we do still have home office. So it is still a very common standard of work here. Just go to the first slide for Germany, maybe. I think that is it, exactly. So just mentioned, we see in Germany, we did see a lot of very strong, very significant government programs that were put out. Just to put them here, I put them here on the slide, but on the left, basically, just to mention three of the largest, we have the KfW loans, which are government guaranteed loans, a significant, almost 50 billion of loans given out to actually support the economy. We had the Insolvency Moratorium also in Germany. It just ended in April, which became a bit of a surprise. It was always planned, but it was already renewed once. So everybody was thinking it might actually happen again, which it didn't. So that became a bit of a surprise. And the other one, unemployment, so the short-term working scheme, which I put out here, basically supporting people to stay at home but still getting paid, and just to actually support that. So all of that was quite helpful for the economy. It also was helpful for the NPLs. If you look on just put them out here, what we've seen in the past since 2015, I just charted them here, showing that the NPL levels have gone down significantly in Germany. And also the NPL ratio has gone down and stabilized and on a very low level. So that's what we've seen. We've also seen that banks have, however, now slowly started to increase levels again. And Alok just mentioned that. Also in Germany, I've just put out 2 examples here of Deutsche and Commerzbank, where you see in brackets also what was COVID related, so the LLP. So you see that actually increased quite significantly. Now, at this point in Germany is more of a cautious measure. The actual defaults haven't increased, so the incurred losses that we've seen so far, and that is expected to be a result of the massive programs that we've seen. And last point, maybe for me, is just sector-wise. Obviously, we've seen the typical sectors hit quite heavily that we heard earlier: leisure, travel, everything around that. Also, aviation, of course, being the new shipping basically in Germany. But due to, as I mentioned, I'm working from home, it is still widely common to work from home here, and we have a question mark out for the commercial real estate sector as well. How's that going to develop? And especially in Germany, you might know that there's always a German Mittelstand, which is the SMEs basically in Germany, and we're not quite sure what's going to happen with them, but maybe we'll touch on that later. So that was the short view from Germany.
Perfect. Thanks so much, Niels. I think moving on, maybe we get Rissa to come in and talk about France a little bit.
Sure. Hi, everyone. So my name is Rissa Nassia. I'm a partner in the financial advisory team in the Paris office. I lead the PLAS, or portfolio advisory activity for France. We advise pretty similar story: banks, debt servicers, PE funds in acquisitions and sales of performing non-core and NPL portfolios. And though you will be told that there's very little activity in France, we've seen quite a bit over the years, luckily. I'll go. I mean, I don't know if you guys want to put up the slides on France as I talk through this. Might be helpful. Okay, so I think there's one slide, but the key messages here is that France is the leading country in terms of NPLs, in terms of NPL stock. Outstanding NPLs on the balance sheet of French banks is around 120 billion, actually now in December 2020, and it's stable since the end of 19. So no major increases like we've been seeing, no decreases. And the corresponding NPL ratio is still one of the lowest in Europe at 2.2, 2.3%, depending which denominator you take. Like the rest of Europe, weakening of macroeconomic conditions impacted by the pandemic. However, what's counterintuitive are the record low levels of individual and corporate bankruptcies. So, I mean, record lows, lower than pre-GFC crisis, lower than we've ever seen in France. And this is, of course, due to the same theme that we've been hearing. I guess you've been hearing throughout the last 2 days. It's around government support measures, so moratoria. Public guarantee schemes, government guaranteed debt, all of this close to 400 billion of support. France also has the largest amount of loans under moratoria in Europe. And so all of this has, of course, prevented a sharp rise in NPLs so far. I think that's the important point. In terms of provisions across the largest French banks, they've more than doubled in 2020, so it's a major increase compared to 2019, but the coverage ratio is still around 55%. It's only increased, let's say, about 2%. So depending on the hypothesis that we take about the market, this can be viewed as fairly low. And then getting kind of in terms of to what Hervé was alluding to, a bit of the market activity, what we've seen is that the pandemic impacted deal flow like in the rest of Europe, lower volume in 2020. There were some notable large trades that happened in the second half of last year, the first half of this year, 2021. But since we can't really assess the impact of the increase of the stock of bad debts, not until we see the end of the government measures and the moratoria, is obviously they're still protecting the defects. We're not actually being able to see what's happening. We're not going to really be able to know how the market is going to progress definitively. But just to give you a benchmark, the NPL ratio after the global financial crisis was around 4.5%. The consensus that, let's say, people smarter than I say is that the level is expected to reach at least 5% for France. And now it's at, again, 2.2, 2.3, depending on what metrics you take. So you can make your own judgment on this, but it's clear that right now there's something protecting let's say the defaults and everything that's going to come later of that. I'll stop there, given time.
Perfect. Thanks, Rissa. I think I might head over to Albert to talk about the CEE region.
Sure. Good afternoon, everyone. My name is Albert Márton. I'm not repeating my colleagues. I'm a partner in the Hungarian practice responsible for the Central European countries. So I'm representing here 17 countries, not only one. And let's just then jump into the market then. So first, a couple of messages here for the Central European region without going into the details of certain countries. The moratoria period is basically over, I would say. So either ended or about to end in these countries. You see one exception, which is Hungary, which is always unique recently. We have been just, or it has been just extended. The moratoria was extended, and it is still running until the autumn. But the exact runout is still not clear. So you can see that basically overall in these analyzed countries, we have less than 20 billion of loans under moratoria, representing on average 6% of overall loans. As I said, Hungary is an outlier here, but for the other countries, this is practically over. Obviously, there is a delay, as in other countries. How that will evolve, we don't yet know. The stage 2, as Alok said, this is a good indicator. Stage 2 percentages increased significantly in the Central European countries. If we look at large banks, the stage 2 percentage has actually almost doubled in most of these countries. But still, I would say the proportion of stage 2 loans is in the range of like 5 to 15%. So if we look at the current NPL ratios in the region, which is on average like slightly above 3%, even if significant part of those stage 2 loans will transform to NPLs, this would not lead us to the double-digit type of NPL ratios which we have seen previously. In terms of the sectors, this is pretty much the same as my colleagues said. Maybe one exception for C, due to the location of the region and these countries, transportation is also affected, and the participation of transportation-related companies is in the moratoria is higher. If you go to the next slide, just a little bit of insight to the NPL volumes. On the bottom left, you see the NPL volumes, where we cannot yet see huge increases. In certain countries, it's even decreased. So we are basically waiting for the next period to come and to see how the addition will evolve and the transformation from the stage 2. And I maybe stop here for the background.
Thanks so much, Percy. And last but not the least, let's move on to Claire to talk about Cyprus. Not sure if Claire's on.
Hi, Claire. We cannot hear you.
No, sorry, I was on double mute. I apologize. I said that, as I mentioned earlier at the beginning of this workshop, there have been significant amounts of effort in the local market to reduce the non-performing loans from one of the highest in Europe all the way to, and I think Chrisa showed it in her slides, to something that is quite sensible and manageable. Now, at the same time, we've had one of the largest volumes of transactions in the secondary market in the past 8 years since the banking crisis locally. Where we are right now is consistent to what every one of my colleagues mentioned. So yeah, here's some numbers. So I'm glad to present that Cyprus is not at the top when it comes to NPL efforts, and at the same time, it has a big chunk of sales. I mentioned earlier that we are facing some challenges, some related to exogenous matters such as the coronavirus, changes in foreclosure law because of the elections. The government did have some good initiatives to try and support both the banks as well as the more fragile, if you like, borrowers. But a couple of the schemes introduced over the past couple of years have not been very successful, which means that the banks will, for the foreseeable future at least, be stuck with a portion of NPLs that they cannot offload to one of the buyers that are interested in this, mainly around retail portfolio, if you ask me. If we go to the next slide, I've just put a couple of thoughts on what's been happening as a result of coronavirus. Similar to other countries just mentioned, Central Bank of Cyprus followed Eba Guidelines and provided some of the most favorable measures when it came to the moratoria. In fact, its schemes were so broad that I think they were considered as some of the most favorable in Europe. these obviously, or a number of these have now ceased, and we are waiting to see the impact as a result. At the same time, our banks, at the request of the European Central Bank, have started looking at their portfolios a bit more closely, especially around significant increase in credit risk. Albert showed the staging impact. So this is something that is has started and we expect will continue and will at some point drive provisions up. All in all, as I mentioned at the beginning of the session, it's a difficult message for our local banks to know that all this effort of the past 7 years is now basically taking a step back as a result of coronavirus. But we remain resilient and committed in making sure that we are well positioned on this.
Thanks so much, Claire. I think just going back to Niels and on Germany. So obviously Germany has seen, significant government aid programs, and there's a view that they're amongst the widest stimulus programs that you would have seen globally. Niels, from your perspective, how do you think this will impact stress and NPL numbers that banks will see going forward? And what do you think the impact will be on portfolio transactions in the coming years?
Okay, well, I have the thankful now task to get out the crystal ball. That's great. Thank you, Alok, for that. Well, it's correct. It's that Germany has had this the widest stimulus programs in the world, and however, all of that seemed to have come to an end here. Not all of it, but some parts have come to an end. Some are reducing, as I've said earlier. So the question is indeed like what's going to happen next. So we've seen, and I think somebody mentioned that as well earlier. We've seen over the past that the workout teams in banks have reduced in general. There's less capacity there, there's less teams there because it was simply not necessary. Now we're seeing capacities being built up again. We're also seeing services coming back and then building up teams, but all of that takes time. And so all of that is it's building up very slowly, well, not slow, but trying to at least do what's possible. As we know, it is not as fast as we all want. In addition, what we also see is actually investors coming back into the market and building up teams and funds there. You mentioned that the capital that has been collected, but also teams actually, especially for the DACH region, are also hired. So all of that together we're seeing is actually happening in the German market. So we do think that portfolio sales could be a viable option in the near future whenever that wave of NPLs hits the market. Now the difficulty here is when is it going to hit, and is it going to be a tsunami or a smaller wave? And I think that's the main questions we're currently discussing. I think you said earlier that we're waiting something like that in maybe next year and then the following. I think, yeah, possibly at the end of this year, but I think that's the earliest. What we're seeing in banks at the moment really is that that single name basis loans are worked out or sold on a single name basis. We're not seeing huge sales at the moment, but on the other hand, if there are portfolios, and we are seeing smaller portfolios coming to market now, also NPLs, as a bank, you are in a very good position to actually sell them at a very reasonable price. So that overall is interesting. And so coming back to the question, I probably see portfolio sales coming back to market, but probably end of the year earliest, probably more likely next year. I think that's the main point. And banks are, somebody said that as well, are better prepared. You mentioned the capital levels. And I think that's a big difference here. Also, banks are now part of the solution rather than part of the problem, as they were during the global financial crisis 15 years ago.
Yeah, no, thank you. And I think that's consistent with the view that we're seeing across other countries in Europe as well, where I think the banks will accelerate bringing to market loans that were, NPLs are already in distress pre the crisis, and the loans that are NPLs as a result of the current crisis probably take another 12 months before they come to market. I think just moving on to to France and Rissa, France historically has had amongst the largest stock of NPLs, in Europe, but there's always been limited transaction activity. And from your perspective, why do you think this has been? And then, as you mentioned, right, historically, obviously the numbers, the NPL ratio has been low at at sub the 3% level, but as it creeps up to 5 or 5+, how do you see that that panning out over the next couple of years?
Sure. I mean, I think that's a question, and there's a couple of points. I mean, France is certainly more immature, less transparent, all of that than other European markets, and it has been for the last about 10 years or even longer than that. And I think it's because of their NPL ratio, one. So when we compare what the NPL ratio is today, and certainly what it was even 10 years ago, it's one of the better ratios in Europe. So it just France has not gotten the same regulatory pressure of its European counterparts, despite the large stock. Also the fairly healthy capital position of French banks, certainly in the last few years. And then the second, I'd say, kind of element that stopped the development of the market is reputational risk. French banks have just always had an issue with, how they view their clients versus debtors, and how would the sale of, NPLs be seen in the market. But I also think, and we always have this debate, Alok, but I also think that it's a market where there's a lot of smaller transactions traded bilaterally or via small auction processes. These don't make the headlines, but they still add up to several billion euros. And then forward looking, I think it's as I was saying, when government measures run out and the real impact is actually crystallized in the market and on banks' balance sheets, then we can see a bit more whether it's going to be a very dynamic year. I can't imagine that starting in 2022, probably the second half of that, we won't see a dynamic year, large disposals, new deleveraging programs. I think it's just natural to conclude that French banks are going to have to implement aggressive NPL management strategies, and part of that is, of course, also sales.
Okay, thank you. I think, Leah, just coming back to you on Cyprus, and I think you talked about a few of these aspects already. But given, Cyprus started off with one of the highest, if not the highest, NPL ratios in Europe post the GFC, and there's been significant effort that's been put in over the last couple of years to bring that ratio down. However, as a result of the current crisis, there would have been a lost tourism season last year, and then potentially this year will be impacted as well. Now that's going to have an impact on the NPLs going forward. And then that coupled with, some of the servicing capacity being carved out by the banks in the last couple of years, how do you see that impacting, the new NPLs and the capacity of banks to manage those NPLs in the coming years?
Yeah, so I think, as I said, I think our local banks are starting to realize that, they have to take a step back compared to all the efforts that have been happening historically. Having said that, I do think they're obviously better equipped, having done a couple of major transactions each. So they now know how to handle situations that relate to either significant increase in credit risk or NPLs, or how to manage portfolios. The local laws, despite the suspension that I mentioned earlier, are more supportive of the whole system of managing non-performing exposures. So yeah, although unfortunate the whole situation, I do think that our banks are a bit more optimistic now than the situation was a few years ago.
Okay, I'll just maybe a follow-on question there. And there's been talk of a bad bank in Cyprus as well. Is that any legs to that discussion, or?
So there have been actually publications in the press about a bad bank. We know from discussions in the industry that there are indeed thoughts around the creation of a bad bank. As you know, Alok, a good example of this is the National Asset Management entity in Ireland. So they are trying to see whether an NAMA model would suit something locally. We haven't had something concrete per se come through, but we do know that conversations are at hand around this. And obviously you may have seen the publications or the information coming out of the regulatory side of things, where they are supportive in some respects of something like this across Europe. So yeah, we await to see what's going to come our way.
Perfect, thank you. And then lastly, I guess coming back to you, Albert, from your perspective, obviously you said you cover 17 countries. How have you seen, transaction activity over the last year and a half? And then how do you, what does the outlook look like from your perspective?
Sure. As you mentioned, the transaction activity in the region was also limited compared to the previous years. So that 60% decrease you mentioned, that would be pretty much valid on average for CE as well. However, the transactions which we have seen, those generated extreme competition in the last year, I would say. Although not many, but couple of those deals, even if the portfolio was of quite low quality, we have seen extreme competition and extreme pricing. So I mean, in the short term, going forward, I would expect that this kind of demand from investors would stay with us. So in terms of from the bank's perspective, I think being kind of a first mover would be definitely beneficial, because we see pricing we have never seen before, and this is obviously due to the fact that these investors need to, and servicers need to feed their machine, so they have significant capacities built up. And
hi, Albert. I think we lost sound. Albert, can you hear us?
I think I might just carry on, right? Given we're getting too close to the session anyways. But I think, talking about what Albert's seeing,
talking to these investors and servicers, they haven't actually downsized their operation. So sorry, can you hear me?
Yeah, we can.
Oh, okay, sorry. There was an echo here. And maybe as a last thought here, that from a regulator perspective, I think that this crisis and the kind of the decrease of the potentially increasing NPL level will not last as long as in the previous crisis. So there is a pressure from the regulators here in the region as well to downsize those NPLs. So we will see how that work out. But this is pretty much what we see in the CE market going forward.
Perfect. Thanks so much, Bercy. And I think what we're seeing in other markets where we worked on transactions for banks over the last year or 6 months more, I guess, is similar, right? Where we've seen funds come in and bid over pre-COVID pricing levels. And this is, I think, a result of significant amounts of money being raised, new entrants, and also there being limited transaction activity in the market, right? So there's not as many sellers. So to your point, I think, if you're a first mover, or if you're thinking of bringing something to market in the near term, it's probably a seller's market to that extent. Just given, I think we're coming up to the hour, I'll probably stop there. Thank you all for attending today, and hopefully you found this interesting. To the extent that we can help with any specific follow-up discussions around specific markets opportunities, please feel free to reach out. I understand the materials from today's session and the other sessions will also be sent out separately. Thank you all to the speakers for your time today, and hopefully you enjoy the rest of the sessions over the coming days. Thank you.